Are you tired of taking trades that never work out? Do you want to stop guessing and start mastering the market with the precision of a pro? Then don't blink, because in the next 20 minutes, we're breaking down one of the most brutally honest and practical trading books ever written, Mastering the Trade by John F. Carter. This isn't just another book about stock charts and theory. It's a real-world, boots-on-the-ground blueprint from a professional trader who's been through the trenches and came out profitable. If you're serious about trading success and not just another wannabe glued to Reddit forums, then this video is your fast track to the mindset, tools, and systems used by elite traders. Welcome to Book Loom, where books become your power tools. Let's dive in, chapter by chapter. Chapter 1. Why Most Traders Fail. The brutal truth they don't want you to know. Let's start with a cold, hard truth that hits like a gut punch. Most traders fail. Not just some, not a few. Over 90% of people who step into the world of trading lose money and eventually quit. Why? Because they don't treat trading like a business. They treat it like a hobby, or worse, like a game. John F. Carter doesn't hold back in this opening chapter. He's seen it firsthand: smart people, motivated people, even financially savvy people who blow up their accounts because they approach the market with emotion, not discipline. This chapter sets the tone for the entire book. It's not about feel-good stories or overnight riches. It's about the truth behind consistent profitability. And it starts by exposing the fatal mistakes of failing traders. The core problem, the 3 M's. Carter introduces a powerful framework that every trader must understand: the 3 M's of trading. 1. Mind, psychology. 2nd method, strategy. 3rd, money, risk management. Most traders think they need just a killer setup or a magic indicator, but Carter reveals that the method is only 10% of the game. The real heavyweights: mindset and money management. Without the right mental discipline, traders panic, overtrade, or chase losses. Without solid risk rules, one bad trade can wipe out a month of profits, or more. Trading is not about winning every trade. It's about surviving long enough to let your edge work out over time. Why amateurs? Blow Up Carter outlines common reasons traders fail. They lack a trading plan. They can't handle losing streaks. They risk too much on each trade. They seek excitement, not consistency. They let emotions control decisions. Worse, many fall into the trap of revenge trading, trying to win back losses with bigger risks. It's a fast track to blowing up your account. Carter shares stories of traders who had talent but lacked control, and ended up quitting trading altogether. He stresses that discipline beats brilliance every single time. The professional trader's edge. What separates pros from amateurs? Structure, routine, self-control. Professionals: wait for high-probability setups. Stick to predefined stop-loss and position size. Accept losses as part of the game. Focus on long-term performance, not one trade. Carter compares it to flying an airplane. You wouldn't want a pilot flying by feel. You want one trained to follow a system, regardless of emotion. Trading is no different. Reframing failure. The chapter closes with a surprising twist. Failure isn't bad if it leads to learning. The key is not avoiding losses. It's about learning from them quickly and adapting your behavior. Every losing trade is feedback. Every mistake is a mirror. Carter urges you to stop asking, "How do I win more?" and instead ask, "How do I trade better?" That shift alone can change your entire trading journey. Now the question is that, if psychology and risk management are more important than the strategy itself, then what's the one mindset shift that turns struggling traders into consistent winners? That's exactly what we'll uncover in the next chapter, where we dive deep into the psychology of trading and how to finally take control of your emotions in the heat of the moment. Chapter 2. The Psychology of Trading. Master your mind, master the market. Let's get real. The greatest battle in trading doesn't happen on the screen. It happens between your ears. In Chapter 2 of Mastering the Trade, John F. Carter takes us into the psychological battlefield that every trader faces, a place where fear, greed, ego, and overconfidence either destroy you or build you into a master. If you've ever exited too early, doubled down on a losing trade, or hesitated just before the perfect entry, this chapter will feel like a mirror. The Silent Killer. Emotions in Trading. Carter starts by exposing the root problem. We're wired to lose money in the markets. Our brains evolved to survive, not to trade. The fight-or-flight response that once helped us avoid predators now sabotages our decision-making under pressure. When the market moves against us, fear triggers us to exit too soon. When a trade goes well, greed urges us to hang on too long and give back gains. And when we lose, ego jumps in, demanding we make it back, often through impulsive revenge trading. The result? A downward spiral, not because the setup was wrong, but because our mindset broke down. Becoming the calm in the chaos, Carter reveals that the top traders aren't the ones with the best indicators. They're the ones who stay calm, consistent, and focused, regardless of what the market throws at them. They know the outcome of a single trade is irrelevant. They focus on execution over outcome, a key psychological shift. To help you gain that mindset, Carter offers practical tools. Journaling your trades, not just results, but your emotions before and after. Mental rehearsal, visualizing your setups and responses before the market opens. Stepping away, literally leaving your screen when emotion takes over, because in trading, discipline always beats emotion. Your worst enemy is you. Carter goes deep into the inner voice, the constant stream of thoughts that second-guesses, doubts, or pushes you to act on impulse. He explains how most traders lose not to the market, but to themselves. He shares examples of traders who sabotaged their progress with self-destructive behaviors, changing strategies after one loss, ignoring stop losses out of ego, chasing trades because of boredom or FOMO. These behaviors aren't just bad habits, they're psychological patterns that need to be consciously rewired. The trader's daily mental routine. So how do professionals keep their minds sharp? Carter outlines a simple yet powerful routine. Pre-market mindset check. Are you feeling centered or emotional? Daily review. What did you do well today? Where did emotion override logic? Mental resets. Walking away, breathing exercises, even stepping outside. Anything to reset your brain after a stressful trade. Over time, these small habits compound into mental resilience, giving you the edge amateurs never develop. Trading is not about being right, it's about being consistent. This is the golden mindset shift. Don't focus on being right. Focus on executing your plan flawlessly, even when it's uncomfortable. Carter says that once you stop tying your identity to your trade outcomes, you free yourself to trade with clarity. You become less reactive, more strategic, and more profitable. Now the question is that, if mastering your psychology is the most important skill in trading, then what tools and systems should you use to make high-probability trades without relying on guesswork or emotion? That's exactly what we'll explore in the next chapter, as we dive into the tools of the trade that every serious trader must have to compete with the pros. Chapter 3, The Tools of the Trade. Gear up like a pro. So, now that you know why most traders fail, and you've started mastering the mental game, you might be thinking, okay, I'm mentally prepared, but what tools do I actually need to trade like a pro? Welcome to Chapter 3 of Mastering the Trade by John F. Carter, where we finally open the trader's toolbox and break down the essential weapons that separate the amateurs from the elite. Here's the truth. A surgeon doesn't operate with rusty tools. A pilot doesn't fly without instruments. And a trader? They can't win without professional-grade tools either. It's not about fancy, it's about function. Carter starts by busting a myth. You don't need 20 indicators or 10 monitors to succeed. What you do need is a clean setup, a reliable data feed, and the right software to interpret and act on market signals fast. He shares his own trading station setup, simple, efficient, and built for speed and clarity, not clutter. Trading platform, your command center. First and foremost, your trading platform is your cockpit. This is where all your decisions are made, and it better be reliable. Carter recommends platforms that are fast, stable, and customizable. Features to look for: clean charting tools, real-time data, hotkeys and fast order entry, integration with your broker. Speed matters. Because in fast-moving markets, a 1-second delay can cost you hundreds. The right indicators. Less is more. Many new traders fall into indicator overload. But Carter warns, the more indicators you use, the more confused you'll get. He narrows it down to a few high-value tools that actually work. 1. Moving averages, especially the 8 EMA and 21 EMA. They help track trend direction and potential reversals. 2. MACD and stochastic oscillator, to identify momentum shifts. 3rd, volume, often overlooked, but crucial. Spike in volume? Pay attention. 4th, Bollinger Bands, great for spotting volatility squeezes before big moves. But Carter's favorite weapon? The TTM Squeeze Indicator, a proprietary tool that signals when the market is building pressure before an explosive breakout. He swears by it, and you'll hear it referenced throughout the book. Charting setup, structure beats. Style Carter recommends multi-time frame analysis. Don't just look at the 5-minute chart. Back it up with daily and hourly views. Color-coded candles and clean charts. No clutter, just what matters. Tick charts and volume charts, especially for intraday setups. Remember, your charts aren't supposed to look cool. They're supposed to help you make quick, high-quality decisions. Risk tools. Protect yourself. First, your platform must include automated stop-loss functions. OCO, one cancels other, orders. Trailing stops. These aren't just options. They're lifelines. Because if you can't control risk automatically, your emotions will take over. And we already know how that ends. Hardware that matters. Carter doesn't push you to buy the latest gadgets, but he does insist on a fast processor, dual monitors, at least, for watching multiple charts, reliable internet, lag kills. He also suggests a quiet, distraction-free workspace. Because trading is a mental sport, and focus is your fuel. One final note: simplicity. Wins Carter's key message in this chapter? Master a few tools. Know them better than anyone. Don't chase every new gadget or signal. Be a sniper, not a shotgun trader. Now that you've built your trading cockpit and stocked your toolkit, then, what's the actual day-to-day process that professional traders use to prepare, trade, and review consistently every single day? We will know in the next chapter. Chapter 4. Market Internals and Setup Conditions. Reading the market's pulse. Let's say you're watching a stock that's about to break out. Your indicators look good. The chart is clean. Everything screams buy now, but you hit buy, and suddenly the trade flops. Why? John F. Carter answers that in this chapter with a game-changing insight. You're trading the stock, but ignoring the health of the market behind it. In Chapter 4 of Mastering the Trade, Carter teaches us how to read market internals, the heartbeat of the overall market, so you stop swimming against the current and start trading with the flow. What are market internals and why do they matter? Think of market internals like a weather report for traders. Just as pilots don't fly blind into a storm, traders shouldn't jump into setups without checking if the market conditions are favorable. Carter explains that even the best trade setups can fail in a weak or choppy market. And this is where market internals come in. They help answer questions like, is the overall market strong today? Are buyers or sellers in control? Is there momentum behind the moves? In short, they help you time your trades better and avoid setups doomed from the start. The core internals you must watch. Carter focuses on three powerful internal indicators. 1. TICK NYSE tick. Measures the number of stocks ticking up versus ticking down. Positive tick, bulls are dominating. Negative, bears are winning. Key tip, watch for extreme readings. A tick of plus 1,000 or minus 1,000 can signal potential turning points. 2. TRIN, ARMS Index. Tracks volume flow between advancing and declining stocks. A TRIN above 1 means volume is flowing into declining stocks. Bearish. Below 1, bullish. It helps confirm the strength or weakness of a trend. 3. ADD, Advanced Decline Line, shows the net number of advancing versus declining stocks. If ADD is rising, more stocks are gaining, a sign of market strength. If it's falling while your stock is rising, that's a red flag. Your stock is moving against the market. Real-world setup conditions. When to strike. Once you understand internals, Carter shifts focus to setup conditions, the ideal environment for entering a trade. Here's what he looks for before pulling the trigger. Internals must support your direction. Long trade, make sure tick and ADD are positive. Major indexes should align. If the S&P 500 and NASDAQ are trending higher, that's a green light. Volatility should be manageable. Carter checks the VIX. A low VIX often means smooth sailing. A high VIX signals stormy conditions. He emphasizes, don't just chase setups, wait for alignment. Because when your trade, your indicators, and the market internals all say the same thing, that's when probability is truly on your side. Discipline over desire. Carter reminds us, even when you're itching to trade, the best decision is sometimes to do nothing. He shares stories of professional traders who sit on their hands for hours, or even days, waiting for all the setup conditions to line up. Why? Because they know. Patience pays more than action. Pro tip: layering internals into your routine. Start every trading day by checking TICK, TRIN, and ADD within the first 15 minutes, watching how they behave during news events, logging their movement during your best and worst trades. Over time, Carter says, they'll become your early warning system, helping you spot danger before it hits and giving you the green light when the time is right. Now that you've learned how to read the market's internal signals and pick the perfect moment to strike, then, how do you actually build a trading plan? One that combines your psychology, tools, and setups into a repeatable daily routine? You'll find out in the next chapter. Chapter 5. The 5-minute rule and opening gaps. Master the market's first move. Picture this. The market opens at 9:30 a.m. A stock you're watching gaps up big overnight. It's tempting, right? You're thinking, should I jump in? Ride the momentum? Fade it? Hold up. Because what you do in the first 5 minutes can make or break your trading day. And John F. Carter delivers a priceless strategy in Chapter 5 of Mastering the Trade that every serious trader should know. The 5-minute rule. A simple, powerful filter that keeps you from getting trapped by emotional, volatile moves at the market open. The 5-minute rule. Explained. So, what is the 5-minute rule? Carter advises that traders wait the first 5 minutes after the opening bell before entering a trade, especially in stocks or futures that have gapped up or down overnight. Why? Because the first few minutes of market open are usually filled with noise, retail trader panic, unpredictable algorithmic moves. Jumping in too early is like diving into stormy waters without checking the tide. Instead, Carter says, let the market show you its hand first. Wait 5 minutes, let a candle form, and then analyze. How to read the 5-minute candle. Here's how Carter breaks it down. Watch the first 5-minute candlestick that forms after the open. If the market breaks above the high of that candle on strong volume, it's a bullish signal. If the price breaks below the low, it's a bearish signal. This one candle becomes your compass. You're not guessing anymore. You're reacting to actual momentum, not hype or fear. The psychology behind opening gaps. Carter dives deeper into why opening gaps are dangerous and powerful. Opening gaps often occur after overnight earnings, news releases, global market reactions. These events can push prices way up or down before the average trader even logs in. But here's the trick. Most of these gaps are faded, meaning they reverse direction shortly after the open. Carter says, if a stock gaps up but can't hold its gain after the first 5 to 10 minutes, it's likely to fade and fall. If a stock gaps down and starts climbing after the first few minutes, it's likely to squeeze higher. Understanding this behavior helps you. Check. Avoid emotional trades. Check time reversals like a pro check. Get on the right side of the move. Early gap fades versus gap and go. Carter outlines 2 key types of gap plays. 1. Gap and go. The stock gaps up and continues to run. You trade it long only if it breaks the high of the 5-minute candle. 2. Gap fade. The stock gaps up but fails to hold and drops. You wait for the breakdown below the 5-minute low and short it. In both setups, the 5-minute candle gives you your trigger. No more guessing, no more panic buys. Just a repeatable rule that brings discipline to chaotic market opens. Bonus tip: combine it with market internals. Want even more accuracy? Carter recommends combining the 5-minute rule with market internals. From Chapter 4. Is TICK strong or weak? Is ADD confirming strength? Is volume backing the move? When the candle, internals, and setup conditions align, your edge skyrockets. Why this rule saves you from yourself. The opening bell is when most retail traders lose money, fast. The 5-minute rule acts like a mental circuit breaker. It forces you to slow down, to wait, to trade with logic, not emotion. It's a tiny rule with massive results. So now you know how to read the market's opening move and avoid the traps that destroy most early traders. But once you're in a trade, how do you know when to get out? When to take profits, cut losses, or let a winner run? In the next chapter, we'll uncover the keys to trade management, so you don't just enter smart, you exit like a pro. Chapter 6. Smarter entries and exits. Timing the market like a sniper. Let's be honest, anyone can click buy or sell. But real trading success comes not from just getting in or getting out, but from knowing exactly when to do it. In this powerful chapter of Mastering the Trade, John F. Carter explains why most traders are either too early, too late, or completely wrong, and how to fix that with smarter entries and exits that feel almost surgical. Welcome to Chapter 6, the turning point where your trades stop feeling like coin tosses and start looking like precision strikes. Why timing is everything. Carter begins with a core truth. It's not what you trade, it's how you trade it. You could have the perfect setup, great fundamentals, supportive market internals, and still lose money if your timing is off. That's why he emphasizes 2 core skills in this chapter. 1. High probability entry zones. 2. Tactful, disciplined exits. Let's break those down. Smarter entries. The power of the squeeze. Carter's favorite high-probability setup is called the squeeze. It's a strategy that identifies when a stock is coiling, getting ready for a powerful breakout. Here's how it works. The Bollinger Bands move inside the Keltner channels. This signals low volatility, meaning the stock is compressing. When that compression ends, volatility expands, and that's your breakout. Carter waits for the squeeze to release, then enters in the direction of momentum, not before. This prevents emotional chasing and gets you in just as the real move begins. Indicators that matter to avoid guessing. Carter uses these indicators in combination. Bollinger Bands and Keltner channels to identify the squeeze. Momentum histogram to time the direction of the breakout. Volume spikes to confirm participation. By using these tools, Carter avoids false starts and only jumps in when the move is likely to follow through. Smarter exits. Stop guessing, start planning. Getting into a trade is only half the game. Getting out the right way is where pros win. Carter teaches 3 types of exits. 1. Target-based exit. Set your profit target before entering the trade. This could be based on prior support or resistance levels, Fibonacci extensions, ATR, average true range. 2. Stop-loss exit. Know your uncle point, the level where if price hits it, you're proven wrong. Key insight: don't move your stop just to stay in the trade. That's how small losses become big ones. 3rd, trailing stop exit. When the trade goes in your favor, lock in profits by moving your stop behind the price action. This protects your gains while giving the trade room to run. Carter's rule: let the market kick you out, not your emotions. The entry-exit formula for confidence. Here's the game plan Carter swears by. Use the squeeze to spot energy-building setups, enter on momentum confirmation, exit at predefined levels with zero emotion. This system removes guesswork from your trading and replaces it with confidence and control. Because once you stop winging it and start following a formula, check. Losses become manageable, check. Wins become scalable, check. And trading becomes repeatable. Now you know how to enter and exit trades like a sniper. But here's the big question. How do you choose what to trade, and when different markets behave totally differently? In the next chapter, we'll explore how to trade across stocks, futures, ETFs, and more, and how to adapt your strategy to each. Chapter 7. The Squeeze Setup. Catching explosive moves before they happen. Imagine this. You're staring at a stock that hasn't moved in days. It's going sideways, boring as ever. Most traders walk away, but you lean in. Why? Because you know something they don't. You know it's about to explode. Welcome to the Squeeze Setup, the most powerful trading weapon in John F. Carter's arsenal. In this chapter, Carter shares the exact formula he uses to catch big moves before they happen, and how you can use it too, even if you've never spotted a setup in your life. This one setup has made millions for traders. And after this, it might just become your favorite play too. What is the squeeze? Carter describes the squeeze as a condition where volatility dries up and the market gets quiet, too quiet. And just like a pressure cooker, that silence doesn't last long. Here's the science. When Bollinger Bands contract inside Keltner channels, it signals that the stock is entering a low volatility phase. These are often followed by massive breakouts or breakdowns as energy builds up and then releases. It's like stretching a rubber band. The tighter it gets, the harder it snaps. Why the squeeze works so well. Carter emphasizes that most traders fail because they try to predict when the market will move, but the squeeze doesn't predict, it prepares. It shows you when a move is about to happen and which direction to trade once the energy is released. This is not guesswork, it's physics. Volatility cannot stay compressed forever. How to spot a squeeze, the indicators. Here's Carter's exact setup. 1. Bollinger Bands, BB, and Keltner channels, KC. When BB goes inside KC, the squeeze is on. When BB moves outside KC, the squeeze is off. 2. Momentum histogram. Helps identify the direction of the breakout. If momentum is rising, expect an upside move. If momentum is falling, prepare for a downside break. 3. Time frame flexibility. The squeeze can occur on multiple time frames, 5-minute, hourly, daily. This makes it ideal for day traders, swing traders, and even position traders. Carter uses this setup across stocks, futures, options, and even ETFs. It's that versatile. Real-world example. Carter shares how he traded Google with a perfect squeeze setup on the daily chart. Bollinger Bands moved inside Keltner channels. Momentum shifted from red to green. A breakout followed with massive volume. He entered just before the explosion and rode it all the way up. The result? A high-probability trade with minimal risk and maximum reward, the holy grail of trading. Why the squeeze is a game changer. Here's what makes the squeeze setup so powerful. It tells you when not to trade during chop. It gives a defined entry point. It offers a clear stop loss. It sets you up for high reward potential. You're no longer reacting. You're strategically anticipating. It's not just about being in the market. It's about being in when it matters most. Now that you've learned how to catch the market before it moves, what if you could use this setup in combination with options and multiply your profits while limiting your risk? Chapter 8. High Probability Trade Setups, where confidence meets consistency. Let's be honest, most traders are out here gambling. They throw money into the market hoping something sticks. But what if you could take trades with the odds already stacked in your favor? Trades that didn't just feel right, but were statistically proven to work? That's exactly what John F. Carter delivers in this chapter. A blueprint for high-probability trade setups that cut the noise and boost your edge, whether you're a beginner or a seasoned pro. This isn't guesswork. It's calculated, methodical, and repeatable. What is a high-probability setup? Carter defines a high-probability setup as one that offers a clear edge, a repeatable pattern, defined risk and reward, consistent behavior across different markets and timeframes. In other words, these are trades that you don't just hope will work. You've got back-tested data and experience saying they will work over time. The ingredients of a high-probability trade. Here's the recipe Carter follows for every high-probability setup. 1. Pattern recognition. Price behavior must match a known pattern, like flags, squeezes, or breakouts. No pattern, no trade. 2. Volume confirmation. Breakouts with low volume, fakeouts. Breakouts with surging volume, now we're talking. 3. Market internals. Use the TICK, TRIN, and volume ratios to confirm overall market health. Trade with the flow, not against it. 4. Momentum indicators. Carter leans heavily on momentum histograms and moving averages. If momentum supports the direction, that's your green light. 5. Risk-defined entry and exit. Every trade must have a precise entry point, a stop loss, a clear profit target. This structure creates discipline, which is more important than the setup itself. Go to high-probability setups. Carter uses here are a few that John Carter returns to again and again. The squeeze, from Chapter 7, a volatility-based setup that predicts explosive moves. Trend pullbacks to the 21 EMA, great for trading with momentum during strong trends. Gap fades, perfect when stocks open far from fair value and snap back intraday. Breaks from consolidation. Tight ranges followed by big directional bursts. Each of these setups has been tested thousands of times in real markets, and Carter provides visual examples to show how they play out. The mental game behind high-probability trades. Carter stresses that even the best setup in the world won't help you if your psychology isn't right. That means, don't chase, don't trade without a plan, don't widen stops just because a trade feels like it should work. You're not trying to be right, you're trying to be profitable over time. Example, the power of 3 to 1. Let's say you risk $100 to make $300 on each trade. Even if you're only right 40% of the time, you'll still end up ahead. That's the core of Carter's philosophy. Trade with probability and math, not emotion or impulse. Scaling in and out. Another advanced tactic covered is scaling. Scale into winners as confirmation builds. Scale out of positions to lock in profits and reduce risk. This keeps your risk dynamic, and your confidence intact. Why this chapter is a game changer. Most traders lose because they trade randomly. But once you build a repeatable system of high probability setups, your trading transforms. You're no longer reacting. You're executing a playbook designed to win. So now you've got the setups. But here's the real question. What if you could supercharge these setups using options and turn every $1 move into $5 or more? In the next chapter, John Carter unveils the strategies he uses to leverage options for explosive returns with limited risk. Chapter 9. Swing Trading Techniques, Capturing the Sweet Spot of Market Moves. Let me ask you something. Are you tired of staring at the screen all day, chasing quick trades with minimal reward? What if there was a smarter way to trade, one that allowed you to capitalize on big market moves without being glued to the charts 24/7? Welcome to swing trading. And in this chapter, John F. Carter lays out his exact techniques for nailing these powerful, multi-day setups that professional traders rely on to build wealth, calmly and consistently. What is swing trading, really? Swing trading is all about catching the middle of a market move, not the top, not the bottom, but the sweet spot in between. You're not looking for instant gratification. You're targeting 2 to 10 days of price action where momentum builds, breaks out, and delivers profits, without the stress of intraday volatility. This strategy is ideal for part-time traders or anyone who wants a high-probability method that doesn't require constant monitoring. The core of Carter's swing strategy. John Carter's swing trading framework is based on 4 essential pillars. 1. Setup clarity. Look for consolidation zones, pullbacks to key moving averages, or patterns like the squeeze. If the setup isn't clean, skip it. 2. Market internals alignment. Confirm broader market health using TICK, TRIN, and up-to-down volume. You want to trade in sync with the market, not against it. 3. If momentum is building, you're in the right place. 4. Entry and exit precision. Always plan. The exact entry price, a tight stop loss, a clear target zone. This takes emotion out of the trade and keeps your risk/reward in check. Pullbacks to the 21 EMA, the bread and butter setup. One of Carter's favorite swing strategies is the pullback to the 21 exponential moving average. Here's how it works. In a bullish trend, wait for the price to pull back to the 21 EMA on the daily chart. Confirm momentum indicators are starting to turn back up. If the market internals support the move, you go long with a stop below the recent low. Why the 21 EMA? Because it often acts like a springboard. When price bounces here with volume and momentum, it explodes higher. This setup is clean, logical, and, when combined with Carter's filters, incredibly high probability. Stacking the odds with time frame alignment. Carter emphasizes the power of multi-time frame confirmation. If the daily, hourly, and 15-minute charts all align, momentum is on your side. If one is out of sync, patience is your best trade. This layered view gives traders a strategic edge in timing entries and exits. The emotional advantage of swing trading. Swing trading isn't just technically smart, it's psychologically smart. You're not reacting to every tick. Overtrading, letting FOMO take over. Instead, you're planning, entering, and letting the market work for you over time. This creates a calmer mindset, which leads to better decisions and consistent profits. Scaling in and scaling out, swing edition. Carter also recommends scaling into swing positions as momentum confirms, and scaling out in pieces to protect gains and ride the trend. This dynamic approach reduces stress while maximizing return. The psychology of swing success. One of Carter's final lessons in this chapter. Don't fall in love with your position. You're not married to a trade, you're dating it. If it misbehaves, cut it loose. Discipline wins. Emotion kills. Why this chapter matters. Swing trading bridges the gap between day trading and long-term investing. It gives traders the best of both worlds. Strategic, data-driven entries, manageable time frames, strong risk-to-reward opportunities. If you want freedom from screen addiction and the potential to compound serious returns, this chapter is your launchpad. Swing trading works beautifully on stocks. But what if there was a way to amplify your returns on those same moves, using options? In the next chapter, Carter reveals how to use options with swing trades to leverage small moves into massive gains, all while keeping risk tight and defined. Chapter 10. Futures and Forex Trading, where speed meets serious opportunity. Let me hit you with a hard truth. Most retail traders dive into futures or Forex thinking they've found the fast lane to riches. But without a deep understanding of how these markets really work, they're more likely to crash than to cash in. In this chapter, John F. Carter pulls back the curtain on the high-speed, high-reward world of futures and Forex, teaching you how to trade them like a pro, not a gambler. Why futures and Forex? While stocks offer great swing setups, futures and Forex attract traders who crave leverage and liquidity, 24-hour access, tighter spreads, macro-level price movement. Carter explains that futures and Forex are ideal for active traders looking to capitalize on fast-moving markets with precise entries and exits. But here's the key. If you don't know how to control risk in these markets, you'll be out faster than you came in. Futures markets, more than just the S&P. Carter focuses on several futures contracts. 1. E-mini S&P 500, ES, the king of day and swing trading. Ideal for price action-based strategies, high liquidity and volume. 2. Crude oil, CL, volatile and directional, great for momentum traders. 3. Gold, GC, excellent for breakout and pullback strategies. 4. Euro futures, 6. E, often moves in sync with global sentiment. Great for macro and Forex-style trades. He emphasizes that you don't need to master them all. Pick one or two and specialize. One market mastered is worth more than 10 markets dabbled in. John F. Carter. Forex, the giant that never sleeps. The Forex market is the largest in the world, trading over $6 trillion daily. It's open 24 hours, 5 days a week, and driven by central banks, global news, and interest rates. Carter focuses on major pairs like EUR/USD, USD/JPY, GBP/USD, AUD/USD. He teaches how economic reports, geopolitical events, and central bank policy drive currency movements. Unlike futures, which are exchange-traded, Forex is OTC, over-the-counter, so choosing a reputable broker is critical to avoid manipulation and slippage. Tools and tactics that work in both. John Carter explains that the same setups used in stock and options trading, like the squeeze, MACD, and moving averages, work incredibly well in futures and Forex. But timing is crucial. He breaks it down. Trade futures during US and European market overlaps. Trade Forex during high-impact news windows, like NFP, Fed decisions, or ECB meetings. Risk management here is non-negotiable. Carter recommends tight stops, defined position sizing, avoiding over-leverage, especially in Forex leverage. The double-edged sword. Here's where Carter gets real. Futures and Forex offer massive leverage, which means massive opportunity and massive danger. For example, one E-mini S&P 500 contract can control over $200,000 in assets with just a few thousand in margin. In Forex, brokers may offer 50-to-1 or even 100-to-1 leverage, enough to blow an account in minutes. Carter's advice? Use leverage like a scalpel, not a sword. Treat risk as your first trade, not your afterthought. The trading day blueprint. John Carter also shares a typical futures and Forex trading day. Pre-market. Analyze economic calendar, market internals. Opening hour. Look for breakout or trend setups. Midday. Avoid chop. Focus on longer setups. Close, review, journal, reset. This structure brings discipline to markets that are open 24/5, helping traders avoid emotional decisions and burnout. Why this chapter is a game changer. If you're looking to take your trading to the next level, with faster markets, clearer signals, and more potential, futures and forex open that door. But without discipline, tools, and strategy, that door becomes a trap. Carter doesn't just warn you, he equips you. So now you understand how to trade powerful markets like futures and forex. But what if there was a way to stack the odds in your favor before you even enter the trade? Chapter 11. Creating a Trading Business Plan. Turning your passion into a profession. Imagine this. You're sitting at your desk, ready to trade, but you don't have a clear plan. No checklist, no rules, no roadmap. Trading without a plan is like sailing a ship without a compass. You'll drift, waste energy, and probably crash. In this chapter, John F. Carter shows us why treating trading as a real business, with a solid plan, is the difference between hobbyists and true professionals who consistently make money. Why you need a trading business plan. Most traders fail because they lack discipline and consistency. Carter stresses that trading without a plan is planning to fail. A business plan is your framework, your guardrails, to keep you focused and prevent emotional decisions. It forces you to answer the tough questions up front. What are your trading goals? How much capital can you risk? What markets and strategies will you trade? How will you manage risk and position size? When will you exit a trade or stop trading for the day? Key components of Carter's trading business plan. John breaks the plan into essential sections. 1. Trading goals and objectives. Define realistic profit targets and risk tolerance. Set measurable benchmarks like % monthly returns or max drawdown limits. 2. Markets and instruments. Choose specific markets, stocks, futures, forex, and stick to them. Specialize. Don't spread yourself too thin. 3. Trading strategy and setups. Detail the exact setups you will trade, backed by your own testing. Specify entry and exit rules, including stop loss and profit targets. 4. Risk management rules. How much of your account can you risk on a single trade? Usually 1 to 2%. Define max daily loss limits to protect your capital. 5. Trading schedule and routine. When will you trade? What are your preparation and review habits? Build consistency by committing to a daily routine. 6. Record, keeping, and review. Maintain a detailed journal of every trade, entry, exit, emotion, outcome. Regularly review your trades to find strengths and weaknesses. The psychological edge of a business plan. Carter highlights that the plan is not just a technical tool, but a psychological anchor. When the market gets volatile or emotions rise, your plan is your North Star. It reminds you to stay disciplined, avoid revenge trading, cut losses quickly, lock in profits wisely. This mental clarity separates winning traders from those who chase losses or get greedy. Turning your trading plan into a living document. John doesn't want you to create a plan and shove it in a drawer. He urges traders to live by it, but also adapt it as they learn and grow. Trading is a constantly evolving business, so your plan should evolve too, based on market changes, new strategies, personal growth and risk tolerance shifts. How to build confidence with your plan. By following a well-constructed business plan, you'll develop confidence in your setups, patience to wait for the right trades, discipline to stick to your rules even in tough times. Carter reminds us, the plan protects your capital, and capital is your lifeline in trading. Why? This chapter is a must implement. If you want to stop gambling and start investing in yourself as a trader, This chapter is your blueprint. Building a business plan forces professionalism, and professional traders survive and thrive. So you've got your business plan, your trading blueprint. But how do you test and prove that your strategy really works before risking real money? In the next chapter, Carter reveals his secrets on paper trading, backtesting, and forward testing, the essential steps to turn your plan into real, proven profits. Chapter 12. Mastering the Mindset, the Final Frontier of Trading Success. Here's the truth most traders don't want to hear. Trading isn't about the market, it's about you. In this final chapter, John F. Carter drills down into what separates winners from losers in the trading game: the mind. You can have the best strategies, the sharpest tools, and the most detailed business plan. But if your mindset isn't right, none of that matters. This chapter is the ultimate key to unlocking lasting trading success, mastering your emotions, beliefs, and mental habits. Why mindset matters. More than anything else, Carter explains that trading is an intense mental battle where fear, greed, hope, and doubt constantly tug at you. Fear can freeze you out of good trades or force you to exit too early. Greed tempts you to take reckless risks or hold losing positions too long. Hope might keep you stuck in bad trades, praying for a turnaround. Doubt can paralyze your decision-making and ruin your confidence. The goal? To manage your emotions so they don't manage you. Key psychological traits of successful traders. John highlights the mental qualities top traders share. 1. Discipline. Sticking to your trading plan no matter what the market does. Avoiding impulsive decisions based on emotion. 2. Patience. Waiting for the right setups instead of forcing trades. Understanding that not trading is often the best trade. 3. Confidence of trusting your strategy because it's proven, not because you hope it works. Building confidence through practice, journaling, and review. 4. Resilience. Accepting losses as part of the process, not as personal failures. Learning from mistakes without letting them break your spirit. The power of mental preparation. Carter recommends daily mental rituals. Visualization. Imagine successful trades and how you'll handle adversity. Mindfulness. Stay present to avoid emotional hijacking. Journaling. Track thoughts and feelings to identify destructive patterns. He stresses that mindset is not fixed. It's a muscle that can be trained and strengthened. Common psychological pitfalls and how to avoid them. The chapter outlines classic mind traps like overtrading, chasing the market to make up losses, revenge trading, emotional trades driven by frustration, confirmation, bias, only seeing information that supports your beliefs, fear of missing out, FOMO. Jumping in late just because everyone else is. Carter provides practical advice to overcome these. Set strict rules for trade frequency and size. Take breaks after losses to reset emotionally. Use your trading journal to challenge biases. Stick to your plan and trust your process. How to use this chapter to transform your trading and life. Mastering your trading mindset doesn't just improve your profits, it transforms how you approach every challenge in life. Discipline from trading applies to health, relationships, and career. Patience teaches you to wait for quality, not quantity. Resilience builds strength to face setbacks beyond the markets. Suggestions to move forward and apply what you've learned. John F. Carter's final advice. 1. Keep learning. The market evolves, and so should you. Stay curious and adaptive. 2. Practice relentlessly. Use paper trading and real trading to reinforce good habits. 3. Review and reflect. Keep journaling and review your performance weekly. 4. Balance trading with life. Manage stress, sleep well, and stay physically active to maintain mental clarity. 5. Surround yourself with support. Join trading communities or find mentors who push you to grow. Final thought to inspire you. Trading mastery isn't a destination, it's a lifelong journey. The markets will always challenge you, but the mindset you build will carry you through every storm. Your greatest edge as a trader isn't your tools or setups. It's your mind. John F. Carter. Thank you for joining me on this deep dive into mastering the trade. If you found value in this series, make sure to subscribe to Book Loom for more insightful book summaries that fuel your success. And there you have it. Mastering the Trade by John F. Carter, a powerful guide that goes beyond charts and strategies to reveal the real secret of trading success. Mastering your mind and building a business around your passion. If you're serious about trading or simply want to sharpen your decision-making skills, this book offers practical wisdom that can transform your approach to the markets and life itself. Now I want to hear from you. Which audiobook should we dive into next on Book Loom? Drop your suggestions in the comments below, and don't forget to subscribe for more deep, insightful summaries that help you grow smarter every day. Happy trading and keep mastering your craft.